Welcome to the debate. Today, we are turning our analytical focus to PROG Holdings, Inc., trading under the ticker PRG. This is a highly prominent player operating within the lease-to-own, or LTO, consumer finance vertical. The central disagreement we are unpacking today really comes down to a single core question. Is PRG a deeply discounted, high-quality compounder trading at a massive margin of safety, or is it a structurally declining value trap masked by severe data corruption and incredibly opaque management disclosures?
It's a fascinating setup because, on the surface, the numbers look almost too good to be true.
Exactly. And to be clear right up front, we are not giving financial advice today. This is purely an analysis of the stock pitch's interpretation and the quality of its evidence. Our analysis relies entirely on a comprehensive buy-side close-read report, screening data, and financial reconciliations covering fiscal year 2020 through the trailing 12 months of fiscal years 2024 and 2025. I am taking the fundamental long side today. I'm going to argue that PRG is a fundamentally sound, grade A durability business that is being unfairly penalized because the market, and specifically algorithmic screeners, are fundamentally misinterpreting standard lease-to-own accounting.
Right, and I am taking the forensic and credit risk side. I look at that exact same source material and I see a massive trap. I argue that PRG represents a highly dangerous mix of degrading capital efficiency, escalating hidden costs, and practically 0 percentile management transparency regarding a looming debt cliff. The apparent cheapness of the stock is an illusion built on anomalous data.
Okay, before we dive into those deep valuation metrics, for the listener, we really need to quickly establish how lease-to-own actually works because it drives all the weird data we are going to talk about today. If a normal traditional retailer sells a refrigerator, they book the revenue and the cost of that fridge immediately. The transaction is done.
Right, but PRG is leasing that fridge to a subprime consumer. They still own the physical asset.
Exactly, because they retain ownership of the merchandise. Over time, that fridge loses value. PRG has to record that loss in value as a depreciation expense. This absolutely hammers their operating income on paper, even if the customer is faithfully paying them cash every single month. So the cash flow is healthy, but the accounting looks distorted.
Distorted is the right word, but I'd argue it's worse than just an accounting quirk. It's actually breaking the financial data feeds that Wall Street relies on.
Well, let's get into the pitch itself. Let me lay out the foundation of the bullish thesis. PRG is, by all rigorous quantitative measures, a classic deep value compounder. When we look at the financial health veto screens from our report, PRG cleanly passes all conditional criteria. It boasts a durability score of 79.7, which places it in the 97.7th percentile of its sector template, page 2. That is a definitive grade A.
But you have to look under the hood of those screens.
Hold on, let me finish the valuation thought, because the disconnect is staggering. If we run the Penman residual income model, which essentially values a company based on the excess returns it generates over its cost of capital, and we assume a highly conservative 0% perpetual growth rate, the business is intrinsically worth roughly $2,316 million, page 4. But the live market cap sits at roughly $1,073 million, page 4.
Right.
We are looking at a 115.7% margin of safety, page 4. You are essentially buying $1 of intrinsic value for 46 cents. Furthermore, the balance sheet is fortifying itself. The company is aggressively accumulating cash, reaching $293 million by the third quarter of fiscal 2025, page 5. They maintain an incredibly comfortable 11.9 times interest coverage ratio, page 7. This proves the business is highly resilient, generating robust cash flows despite some cyclical top-line softness. The core pitch is that this cash generation gives them an enormous capital buffer.
Okay, but this is exactly where the narrative falls apart for me. That bullish thesis relies heavily on severe data anomalies. Morningstar is currently reporting $2,000 million, $2 billion with a B, in free cash flow for PRG, page 11. That implies an 88% free cash flow margin. I mean, it's not just an error, it's an absolute mathematical absurdity. Wild figures. When you look at SimFin and CompuStat, they peg true free cash flow somewhere between $126 million
and $233 million P11. The automated screens you are citing for that grade A durability are digesting corrupt data. And when you strip away those artifacts, you see a business suffering from severe secular erosion. Look at the return on invested capital. ROIC has dropped 910 basis points over 5 years, falling from 32.1% in 2020 to 23.0% by the third quarter of 2025, P14.
A 23% ROIC is still vastly outperforming its cost of capital.
But the trend is structurally negative. Meanwhile, restructuring charges have quietly escalated by 152% over 3 years, reaching $22.7 million in 2024, page 18. This is exactly why the machine learning track assignment consistently hits the stock with a reject flag across all 5 years of the data set, page 20. And it's why management's candor score sits at a dismal 5 out of 10, page 21. We are looking at a very high forensic risk scenario.
I hear the concern on the data artifacts. I fully acknowledge that the raw Morningstar feed is flawed, but let's look at the Penman model again, which actually normalizes for those errors. The market is currently pricing in a perpetual growth rate of negative 6.44%, page 8. That implies permanent compounding earnings contraction. That level of extreme pessimism is just mathematically unwarranted.
Is it?
Yes. Trailing 12-month revenue has clearly stabilized at $2.4 billion, page 6. It has effectively halted the heavy declines we saw in 2022 and 2023. At the same time, adjusted operating margins are very healthy at 14.5%, page 10. Even if we stress test the weighted average cost of capital, pushing the WACC up to 8.59% to account for the specific risks of subprime consumer finance, the intrinsic value only drops to roughly $2 billion, page 9. That still leaves us with an 86.5% margin of safety, page 9. So the valuation cheapness is real, even when penalized for risk.
You're quoting that 14.5% adjusted operating margin, page 10, but that is completely masking the GAAP reality. SimFin shows 15.0% for fiscal 2022, but if we look at CompuStat's actual GAAP operating margin for that exact same year, it is only 7.9%.
Because of the lease merchandise depreciation.
Exactly. For a lease-to-own company, depreciation of those physical assets is a massive, unavoidable structural cost. You can't just adjust it away and pretend you have a 15% margin business. And let's talk about the free cash flow yield. The raw data shows an absurd price-to-free cash flow multiple of 0.54 times. That means you're supposedly paying 54 cents for every dollar of free cash flow. That's not a bargain. That is a blaring red siren.
Why? It's cash in the door.
Because it prices free cash flow at roughly 14 times net income, P12. In the lease-to-own space, when cash flow so wildly exceeds net income, it signals transient portfolio runoff. They are simply collecting cash on old leases without originating new ones. That cash flow spike isn't sustainable operational productivity, it is the mathematical exhaust of a shrinking portfolio.
I think that portfolio runoff argument assumes a structural decline that simply isn't there. The fundamental operations of PRG remain highly efficient. We are looking at a 29-day days sales outstanding, or DSO, page 13. That is incredibly fast cash conversion. And going back to the algorithmic reject flag you brought up, that is a textbook domain shift error.
Explain what you mean by that in this context.
Think of the algorithm like a bouncer at an exclusive tech stock nightclub. PRG shows up wearing a consumer finance uniform. The bouncer rejects it instantly. Not because PRG is a bad company, but simply because it doesn't fit the algorithm's predetermined dress code for what good margins look like. The algorithm flags PRG's 92.8% gross margin, page 20, and its incredibly low EV to EBITDA multiple as completely anomalous, page 20. It thinks these numbers are impossible.
Well, they are impossible for a normal retailer.
Right, but again, in lease-to-own accounting, merchandise depreciation sits below the gross profit line, which wildly inflates the gross margin, and the lease payments inflate the EBITDA proxy. The algorithm is screaming reject simply because it doesn't understand the specific accounting mechanics of the consumer leasing vertical, not because the underlying business is actually failing.
Okay, I will concede the accounting quirk regarding the gross margin. I'll even